I'm Chuck Marston, Principal in the Tax Group at SR Snodgrass. The new Basel III rules became effective for most community banks beginning January 1, 2015. The new rules require a different, and in some cases more detailed analysis of an institution's deferred tax assets, also referred to as DTAs, in order to arrive at any possible disallowed DTA for Tier 1 capital purposes. Before discussing the new rules, let's quickly review the old method of calculating your disallowed DTA. Prior to Basel III, DTAs were to be supported by recoverable taxes paid in previous years and the lesser of the tax on a modified projected 12-month taxable income, or 10% of Tier 1 capital. Any remaining DTA was to be considered disallowed. The new rules for calculating the disallowed DTA under Basel III require a different approach, which starts with separating your deferred tax items into three different buckets. The first bucket is made up of all of your carry-forward items, not eligible for any realization through carryback. These are immediately treated as disallowed. Bucket 2 consists of all other deferred tax assets, and Bucket 3 includes all of your deferred tax liabilities. When placing your deferred tax items into their respective buckets, be sure to do so net of any valuation allowance that may have been set up. Failure to do so could result in an overstatement of your disallowed DTA. After disallowing carry-forward items, the next step is to determine what amount of your remaining net deferred tax asset could be realized through a hypothetical carryback to allowable previous tax years. This amount is considered a good deferred tax asset, similar to the treatment under the old method. What you are now left with are deferred tax items that are dependent on future taxable income. The amount of this remaining net deferred tax asset that exceeds 10% of your Tier 1 capital will be considered a disallowed DTA. As an added limitation, the combined total of these DTAs and your mortgage service assets and investments in other significant financial entities cannot exceed 15% of your Tier 1 capital. One area of uncertainty relates to how the deferred tax liabilities grouped into Bucket 3 are to be netted against your deferred tax assets. One question is, should you net your deferred tax liabilities against deferred tax assets before or after the hypothetical carryback to previous tax years? Second question is whether the netting takes place before or after the elimination of the DTAs related to the carry-forward items. While the answers to these questions are still unclear, what is clear is that however an institution decides to net its deferred tax liabilities, it must remain consistent. A few other things to keep in mind. First, similar to the old rules, many institutions are able to make a one-time permanent opt-out election for other comprehensive income items. Second, the reduction of Tier 1 capital due to disallowed DTAs under Basel III is phased in over 4 years. Third, when calculating your taxes recoverable under a hypothetical carryback, you are no longer allowed to offset federal items with state items. They must be kept separate. Finally, some allowable DTAs are subject to a 100% risk weighting, while others are subject to a 250% risk weighting. For years, institutions have wrestled with the regulations and done their best to accurately reflect their disallowed deferred tax asset when calculating Tier 1 capital. Nothing in Basel III makes this exercise less important, only different. The new rules need to be understood by every institution, not just to ensure that your calculation can withstand regulatory scrutiny, but also to be sure your Tier 1 capital gets reduced by as little as possible. I hope I was able to shed some light on this topic for you. If you'd like to discuss in more detail, remember, we're always here, so give me a call or send me an email.